All right, it looks like we are live. Hey everybody, welcome to the second live session for the Digital Stock Summit. I hope that everyone is enjoying all the content so far. And for everyone who was watching our live Q&A last night, hope that you all got a great experience with that. Tonight's guest is Ben Ryan, our keynote speaker. He'll have his own session coming up on Friday. So this will be kind of a fun little kind of an intro, I guess you could almost say, to your world of options and gold. And I think with that, I'll just kind of let you give a little introduction of yourself and tell us a little bit about you and who you are, what you're doing.
All right. Well, thank you for the introduction. My name is Ben Ryan. I am the founder of optionshedger.com, which is a new website that a couple friends of mine and I are building, which is focused on providing news about commodities markets as well as options education, because I think there's a real world out there of people who are interested in learning about options. And I believe that some of the people I work with and trade markets with on a daily basis, that the group of us really have a pool of knowledge from what we do on an everyday that might be helpful to some people who are interested in learning more about options. So very briefly about myself, I've been writing about commodities markets and trading in some form or another for about the last 5 years. The last 3 years exclusively, I've been running my own book on gold options and futures. So my job is, my company came from what was historically known as being a market maker. So we were the guys in the pits when brokers would come and ask for orders and say, a fund wanted to get something done, or a commercial hedger wanted to get something done. We represented the liquidity that they came to in the pit, or in the ring, as it said, and did market making, where the idea was that money was made by buying on bids, selling on offers, spreading positions in a way that is profitable based on concepts of options theory, as well as some speculative ideas that we might have about the market, or ways that we could put on trades at reasonable prices. Our world has changed a lot in the last few years, as far as just the switch to so much of the trading going online and OTC, tighter markets on the screens. A lot of things have changed, but I don't want to go into too much detail. I'd rather use this as a platform for anybody who has questions about how our business has changed. If you have an interest in metals, specifically commodities, if you want to talk about options theory, I'm here to talk about any and everything you guys want. So please don't be shy to ask questions. And no matter if you're a novice or you've traded options for a while, no question is too smart or too stupid. But I'll do my best to answer as well as I can. So with that, I'll turn it over to anyone who has some questions.
Yeah, and definitely while we're waiting for a few of those to come in, since our audio and video is a little bit delayed from the chat box. So as anybody has any questions, go ahead and throw them in the chat box down below the video, and we'll answer them as they come in. In the meantime, Ben, do you trade your own positions, or are they like company positions? How does that work?
Sure. So the way our company is structured, as I said, we are what was traditionally a market making firm, and the way that our structure works is I have full discretion over my book. If in the event that things went really badly, that discretion could be pulled. Fortunately, that has not been the case. But I take a percentage of the profit on that book. But the decisions, the risk management of the position, for the most part, is all mine. I actually began trading. I worked as an assistant for my current backer for a couple of years, and then went through a training program with options, where I learned how to trade options, and then got the ability, as I said, to start trading specifically my own book in gold about 3 years ago. I did a year working with someone as their assistant, but sort of taking discretion on positions as well in cotton, which is a completely different market when you're dealing with options on the agricultural side. I know a little less about that, but if anyone has questions on some of the differences between metals trading and other commodities, soft commodity options, I'm happy to take a crack at answering those as well.
I'll even give you the kind of softball one to start off with, of just what's different between commodities and I guess like options for equities?
Sure. So one of the things that's the main difference is when you're dealing with equities, particularly when you have stocks that pay dividends, you're dealing with an entirely different income structure that doesn't exist when you're trading options on strictly futures. So in our world, where the options that we trade are based off of COMEX gold futures, and the way in which we trade them, it's going to be different simply on the basis of the fact that the product as a commodity is different, right? And within commodities, you're going to have different types of trading as well. So I referred to cotton. You're going to have, in some markets like cotton, you're going to have commercial hedgers or producers or farmers who have a real need to hedge their position. And in some markets, a lot of times, as the market maker, you're taking the other side of whatever position it is that a commercial hedger might need. For a simple example, if a cotton farmer cotton farmer can sell options or sell futures in the open market at a price that allows them to lock in a guaranteed profit going forward on a particular crop to take out some of the volatility and pricing that might come from weather or something of that nature, that can change the dynamic of a market a great deal. The supply and demand dynamics within a market like cotton is going to be based on things that are really affecting the growers, the producers of cotton itself. Whereas stocks, of course, you're dealing with a very different ballgame because the things that affect the pricing of stocks and the options of them and the people who trade those options and their motivations are different. So my expertise in Friday's piece that you'll be releasing, I actually did a conversation that will be released on the site, and I talked about, and what I talk about, just to give you a little preview, is stocks and using options to hedge a stock portfolio. So even though my background is more on the commodity side, from an options perspective and from a strategy perspective, the same principles apply as far as if you're a natural long or a natural short in the market and trying to use options to hedge your position. Options theory still holds true. And the same type of analysis, even though there are differences between stock and commodity options, generally the type of analysis that you're doing to determine whether or not you're getting good value on your trades or good pricing is very similar analysis. So if people have questions regarding how to understand what's cheap, what's expensive, or how to put on a certain type of concept using options or when to use options, all those questions, whether you're trading in the agricultural space or the metal space or not in commodities at all, in single name stocks, the principles generally apply in a similar way.
Okay, so it sounds like a lot of it really, I guess, kind of comes down to the different forces that will be affecting the underlying commodity. Is that kind of fair?
Correct.
Okay.
And one thing that's interesting that we've noticed is that volatility in general, and volatility is a word for movement, but we use the term volatility when we're talking about options as the how expensive options are. So if you want to buy calls or puts or sell calls or puts, how much premium these options have. And naturally in a market where you want to be buying options, you want to spend as little premium as possible to get as much potential in the case that the underlying moves as possible. So what we look at and what I spend a lot of my day looking at is how I can try and capture what I believe to be generally underpriced or overpriced options based on the bigger picture of what's going on within a particular market. So if, for instance, the indicators, and you can look at technical indicators if you're that kind of trader, for instance, right? If you have a reason to believe that a market is going to be in a range, but the volatility or the price of options within a particular market, such as gold, let's say they're on the higher band of where they've been historically, and this actually happened recently in gold after this major run up. You saw a few people after the rally started to stall really look to actively sell options because they viewed options as expensive relative to where they had been historically, and people who who are sellers of options naturally want to see the market sit or not move so that they can collect the premium on the options they're selling. So in our world, we're looking for opportunities or doing our best to try and find spots where we can let our perception of risk within the market be reflected using the options. So if we believe they're underpriced, we tend to buy them. If we believe they're overpriced, we tend to sell them. But more often, we're looking actually on the day-to-day for opportunities to buy one option and sell another option that has similar risk characteristics. And that's how we build an options portfolio, where we believe that theoretically we're getting paid to buy similar options and sell similar options against each other, and that the price that we get to do that allows us to make a profit. And that is another part of what we're doing on our day-to-day.
Okay, so I think actually, we've got a guest 289 in here who is understanding my position over here of not really knowing too much about options. So I'll be the one to ask the dumb question.
Sure.
Maybe you could, I guess, give us a really quick overview of, really what are options and what's really their role in the financial markets, since I'm sure that there's more than two of us who are options newbies. As everyone will see on Friday, I get my butt completely handed to me when talking to Dr. Ellman, the blue collar investor. He's all about options. He gives me a full full workover on teaching me there. But since we haven't gotten to that yet, maybe you could just kind of give us a quick intro to options, just to make sure everybody's on the same page.
Sure. So I'll try and back up a few steps, and then guys, please just type all your questions. Happy to get as granular as you like. So take the idea of, let's just say you have any asset. Let's just call it the stock market that trades 100. Okay, just as a simple number. What an option is it's the ability, but not obligation, to buy or sell either stock or futures at a certain price for a certain price. So very simply, if this asset that we are trading is worth 100 at a current time, and we think it's going higher, but we don't want to buy it. We think it could go down a lot, but if it goes up, we think it could go up a lot. In a situation like that, you might want to buy an option, because the thing about buying options is as a option buyer, your max loss is the premium that you pay for it. So when I use that term premium, there's a price on any given option. So if on this asset that's worth $100, the 110 call a year out trades $2, that's the premium. That means literally, if you want to buy that call, the call gives you the right but not obligation to buy, let's just say, the stock at 100. So if I pay $2 for the 110 call, my break even, I start to break even once it goes above 112, because I have the right to buy the stock at 110. That's the strike that I bought. Unless it's trading above 110, I wouldn't want to exercise that right, because I could just buy it cheaper in the open market. But if it's trading let's say it goes to 200, I spent $2 of premium on that option, that call option, and I get the right to buy at 110. So the difference between 112 and 200 is $88, and that would be my profit on a trade. I would have spent $2 for, again, the right but not obligation to buy futures or the underlying asset at 112. Now, people use options for all sorts of reasons. The question is actually a lot harder than it sounds. Originally, in the example I gave before with something like cotton, you might have people who say, who want to collect premium, who are natural option sellers. So let's say somebody in cotton, let's say cotton's trading $50. Somebody might be a natural seller because they can produce cotton for, let's say, $50, and it's trading $50, but they think it's going to sit still. Well, they can afford to sell those, 60 calls or something like that for a certain amount of premium, because once it goes through the strike, they make more money selling it in the open market. So they essentially, they'll cap their upside by being a seller, because their business naturally allows them to sell at a certain price, because their actual business, if they can sell at that price, it's a good thing. It's like they'll miss some of the upside, but they're okay with it because they collect a certain amount of premium over time if nothing happens, which if they weren't hedging using options as sellers, they wouldn't have that opportunity. In the example I gave, which is a speculative case, you might buy options on the 110 call in this asset that trades 100 for $2 because you think over the course of the next year, maybe nothing happens. But let's just say you think there's a 1 in 4 shot that it goes to 200, or 1 in 10 shot that something crazy happens. Well, if you think about it, if you spend $2 on that call, the 110 call, and it goes, and so your break even is anywhere above 112, you start making money. If you made, as I said, if it goes to 200, if you made 88 bucks on that trade and you only spent 2, you made 44 times on your money, right? So that's the idea of options, is at particular times when, especially when the volatility gets low, if you're of the mind that maybe nothing happens, but if something happens, something big could happen, that's a time to be an option buyer, because you can lose a fixed amount of money or invest a fixed amount of money on a bigger trade or on a bigger concept trade looking for some sort of a big or real move. And you don't have to deal with losing if, you know, the stock goes down small. You're capped at the amount of money you spend on the premium. Sometimes that's a good idea. Sometimes it's a bad idea. But from a speculative standpoint, sometimes options allow people the ability to have a levered exposure to a particular direction, the ability to get long for a big move without having to own the stock, so to speak. That's another reason someone might use it. So let me take a look. Looks like we have a question that came in from Johnny.
Yeah. So,
okay, you want to read it, Jake?
Yeah, I'll go ahead and read that one. So Johnny says that he's been dealing with straight equities for 2 years, and that's all he's ever known and traded. Options always interested him, but he didn't know how to trade them. So he understands the purpose, dynamics, and structure, but never understood the actual mechanics of making a trade. So could you walk us through the steps on how to place a trade, what we're looking for on a level 2 screen, if technical analysis is the same as equities as it is for options? So we've got a couple different ways that we can break this down.
Okay, all good questions in there.
Yeah.
So I'll start with the first one. So options, I didn't know, I understand the purpose, dynamics, and structure, but I've never understood actually. Okay, so in the example that I gave, right, where you bought the 110 call on the stock that trades 100, you literally, what you can do is when you bring up a screen, when you have an execution platform, and different execution platforms have different layouts, but what you'll find is you can look through and you'll see usually a list of strikes. So what I talked about was the 110 call in this particular phantom or made up example. What you'll see if you go to the 110 strike is you'll see a market. Usually it'll have a bid and it'll have an offer. The bid is where you can sell that option. The offer is where you can buy that option. And if you want to bid or offer in between, just the same as if you were putting in an order on the, on a particular stock with a limit, it's all the same as far as that goes. So what you would look to do in the case of the example that I gave, perhaps you see the 115 calls that are trading at a certain level that are cheaper and you want to buy more of those, or you see the 105s. You can look at the different strikes, and if you're looking to just buy a particular option, then you decide what the strike point at which you would want to get long would be, how much premium it costs, how many you want to buy, how much premium you have to spend if you're a long player, and that would be your way of going about it. Now, before I get into the technical analysis, and yes, I do think I'm personally not a technical analyst. I use it, and I use the knowledge of people who are better at it than I am to help guide the trades that I do. But before I get into that, I'd just like to say, selling options, there is a lot of, and this is a big part of what I talk about in what Jake will release on Friday. Selling options comes with a lot of risks that add a lot more complexity than tends to meet the eye of people who are new to options trading. I can say, as somebody who spends quite a bit of time trading and constantly learning and trying to get better, learn from mistakes, and learn from good wins. I can say personally, trading from the short side in options can become very complex. It's a lot harder because when you're short an option, you no longer have the right but obligation. As we discussed, other people when you're long an option, you can lose the premium you own, but the option is yours. You're sort of in control. And I would just say to anybody who's watching this, the most important thing when doing any sort of trade is to, first of all, start small, but especially on the option side, I would not initiate from the short side, especially just because so many risks come with it, and it takes a lot of experience and understanding to know when to trade from the short side. And it's often a lot more challenging than meets the eye, or than a lot of people would tell you it is. So that would be my first just word of caution. Options can be very profitable, but from the short side, if you're not sure what you're doing, they can cause major pain. So from a technical analysis perspective, let me just give a very basic example. And I'm going to keep going back to this 110 call example that I gave just to try and keep it simple. So if technically you look in the market that's trading 100 right now, and you take a look, and whatever your technical analysis is, the way you view it is you say, look, this is the kind of market where I could see absolutely nothing happening. Take a stock, for example. Let's say you think a stock has the potential to get acquired. Okay, this kind of example, or you think a stock has the ability to just blow people away with earnings because they have some sort of technology platform that you think is vastly underappreciated in the market. But you think that stock's going to go broke if they don't secure some funding over the course of the next couple months, or you think they're just going to chop along and nothing much is going to happen. But you think that there's that 1 in 5 shot, as I said, there's some chance that technically, from your viewpoint, the thing that trades 100 could just break out and go to 200, as I said, and have an extreme move. In that particular case, you might look to buy options where the move that you're expecting is confirmed that costs you the least amount of money. So if, for instance, a stock is trading 100 and you think above 110 means that the stock has really broken out, you don't have to buy the stock here. You can use your technical perspective to say, maybe I want to buy the option, and that way I don't have to look at it. The concept is not that I expect this stock to go above 110, but that if it does, the amount I get paid, because that move can be extreme, can be great given the price of an option. And again, in this case of the $2 option, if you buy a $2 option on the 110 call and it does go to 200, you're looking at 88 versus the $2 you spent. That's a 44 times return. Anybody probably in this chat would, if someone could say, well, I'm going to guarantee you 12 to 15% returns for life, year in and year out, we'd probably all jump and take it and never risk another dollar of ours. Now consider what I'm talking about. 44 times on an investment, you're talking about 4,400%. So that's an incredibly extreme example, but I want to give kind of that extreme example just to show the degree of leverage or take in a spot where the options are priced in such a way that you don't believe the market reflects your view that above 110, this thing could really break out. It's basically the concept that if you were looking at it technically, if you had levels where you thought major breakouts could occur and they weren't priced in the options, then you take a look. And again, it's just premium versus where you get to buy your futures if it's a call option, and where you get to sell them by the time of that expiration. If you get to buy the 110 calls and it's trading 130, that's $20 on 2. That's a 10 times return. You might get zero return the majority of the time. In fact, you would be expected to get nothing back and lose your $2 the great majority of the time. But for those times that that's not the case, you can do very well. So
really quick to kind of piggyback in on that one, I think another kind of relevant point is the you kind of touched on it there, the expiration dates.
Sure.
How do expiration dates work? Because I know that there's so many different time frames that you can look at, and
Sure.
how do those work? Are you allowed to exercise your options before then, or are you supposed to wait till a certain time? I think that'd be kind of a good, really quick little follow up there. And then Johnny had a couple other little questions in here that we can touch on.
Great. Thank you, Johnny. Keep them coming. So expirations, it depends on the product. Different products have different amounts of expirations and different amounts of liquidity within the market. So you might have, for instance, in gold right now, I believe options trade out to 2020. It's rare you see too much trade behind 2018, and stuff is constantly trading, and you have a tight market on everything 3 months out. So the number of expirations is not necessarily everything you're going to be able to trade, even though they might have more listed expirations within given products. So the type of expiration really depend that you would be, if you're a long option player, the expiration that you're looking for, if you wanted to get really, further along with it, Johnny, to think about it. If, let's say you're a very detailed technical analyst and you somehow come to the conclusion that if a move is going to happen, it's going to happen in the course of 2 to 3 months, right? You're going to probably want to have an option trade with an expiration that reflects your expectation of movement over that time. So if, for instance, in the example we said, if it goes above 110, this stock could really break out. If you're not, if you also, as an added, as an added concept of the trade, if you think that it's going to happen in the next 3 months, if it happens, not further back, then you'd be better off buying the shorter dated option to get that kind of exposure. Now, why would you be better off getting the shorter dated option? Naturally, the longer amount of time that an option has to expiration, the more what's called time premium exists. An option, anytime someone gives you an option, the longer you have that option for, the more you're going to have to pay for the extended time that you have that option. So if your concept is that this thing's going to break out and it's going to be in the next 3 months, it might not make sense to be buying the 110 calls a year out and spending $2 if you might be able to buy them for, a couple of pennies on the dollar, 50 cents instead of $2 or something like that. Because if you get your breakout in the short period of time, you will have gotten to buy more futures at that strike for a lower price, because you are paying on a shorter duration option with an expiration that is sooner. You'll be paying a smaller premium, because that's naturally how it works. Time premium for the same strike, that is, over time, you will, in almost all cases, certainly with stocks and the commodities I trade, you will always see that you pay less for shorter dated options on the same strike. And that is something, that when you're doing your analysis of the kind of trade you might want to put on, you should be considering, again, to go with the idea of technical analysis, what kind of time frame your expectations are for the potential movement or breakout of this stock, and accordingly, decide which strikes with which duration for what premium you'd want. And again, the simple thing, guys, for everyone who's listening, who's new to options, you're going to hear when people talk about options, I find it personally, when I hear a lot of people talk about options, or when I was just learning, people start throwing out a lot of complex jargon that can make the whole thing just seem overwhelming. And I would urge people, as they're just beginning to learn about options, to really focus on making sure that they understand the basics of what's actually at work, rather than some of the terminology that surrounds and the way that people get complex in analyzing the actual pricing of an option. So in the case of the 110 call, just understand that when you're buying an option and you're just buying it without selling anything against it, you're just buying the option outright. If you're buying a call option, you have the right but not obligation at any point until that expiration to buy futures at that particular price. If it goes, however far above that strike it goes, is how much you will make before that expiration, or at expiration. So think about it at expiration. So if the 3 month 110 call costs 50 cents, and in 3 months we go to 115, the simple math you do is to say, okay, I spent 50 cents. That's 50 cents lost, assuming nothing happens. Once it goes above 110, I can buy futures here or buy the stock at 110. So 110 and a half is my break-even point. Above that, you are, for every option you get, you're going to get, I think in stocks, it's usually 100 shares of the stock or whatever it might be. But your appreciation is the amount of at expiration is the difference between what you paid, the strike, and where it settles, assuming you take the trade-off and hold it to expiration. Now, Jacob, just to your point, you asked the question, do you want to exercise the calls early? The answer is usually no, especially in an illiquid market, because there's still time premium to an option. So if we go to through the 110 call, the 3-month option, and let's say we're trading 115, the value of that 110 call is going to be greater than $5. You could just take that the $5 difference from 110 and say, okay, well, I'll just buy futures at 110, exercise the option, then sell them out in the market at 115, and that's $5. The reason you might not actually want to do that is your option is actually worth more because you're not obligated to own that stock at 110 if it goes back below 108. So you do have the option, and there is actually a time premium to that in the money option. So you might be better off, especially if it's a liquid market. You'll probably get more premium and actually get a slightly better return selling the option that you bought out directly, as opposed to exercising early and then selling the stock out accordingly. I hope some of that made sense.
Yeah, I think that was a pretty good explanation of that.
Okay.
So I want to make sure that we finish up here with the last of Johnny's questions. He had one up here. He said that we did touch on the dangers, I guess, of the leverage side of things. But above that, he had another question here of when learning options, how do I not get overwhelmed with the strategies that are always thrown around, such as butterflies, condors, collars, etc.? And what is a reasonable way to get started getting some first-time experience?
Okay. And some option traders are always giving out warnings about the amount of leverage used in options. Can you explain the leverage in options and the dangers of it? Sure. Okay, so the way the leverage, okay, so there are different, leverage is one of those loaded words, and it can mean a number of things. When I referred to leverage and when I use the word, what I think I really intend to say is that you're capable of getting returns that are greater than you would if you just bought the stock on extreme moves, right? Because if you think about it just logically, if you had to buy this stock at 100, there's a certain amount of margin you might have to put in your portfolio. There's a certain amount of money you have to have up to own this. But if you own options, and I don't know, it depends on your deal with your clearinghouse or with your broker or how it works. But when you own options, the most you can lose is the premium. So there is a fixed amount up front that you're going to be paying. But just think about the example of the 110 call that I gave 3 months out. If you're paying 50 cents, Johnny, you're in a situation where, let's say you bought 100 of them. Okay, that would be $50 in premium. Now, let's say you just decided to buy whatever the equivalent is, you decided to buy 2 shares at 100. Well, I guess that'd probably be, you decide to buy 10 shares at 100, let's say, okay? So you decide to buy 10 shares at 100. So what happens in the case where we go to 150, right? If you had just bought the 10 shares of the stock at 100, you would have made 50 times 10, you would have made 500. But if you had been able to spend just the $50 on that option premium, you're now going to own 50 futures of the stock from 110, and you're going to make 2,000 or 40 times 2,000, which is going to be obviously a multiple of just owning the outright shares. So again, it depends. If you go to 111, right? If you had just bought the 10 of the stock and you go to 100 and you go to 111, you make the $11. That's 110 owning the stock. If you own the calls, you might own 50, but you only made 50 cents or 50 cents on it because you spent 50 cents and you're buying them at 110. So you actually did better just owning the stock in that example. So the leverage, the concept of leverage, what I really mean to say is that there is an exponential return that you have on a big move owning those options. Because as you go higher and higher and higher, if it's an extreme move, as I said in this particular example where I thought of like 10 shares as an equivalent of owning, or instead of owning 50 options, once you go really far away, yeah, it's true, you missed the first $10, but you own 5 times as many of the options, and on a big move, you're going to have a outsized return. And as if you remember before, I was discussing on a $2 option that goes to 200, 44 to 1 on your investment. Again, we're talking about numbers that can get big on extreme moves, and that's where options, that's what I refer to when I'm talking about the leverage. On the short side, it's the same thing. You can never be short. If you ever are taking options from the short side, just understand that you can never be short more than you would be comfortable being long or short of the outright. In other words, I can sell 10 options perhaps, because as it goes through my strike, I might be comfortable being short 10 of the underlying if I'm short 10 calls. Or I can sell the puts if I'm willing to get long 10 of the underlying, 10 stock shares at a certain price. But from the long side, I can get long 500 futures if I buy the smallest thing on the board for a tick and the market goes goes exponential. You're going to be participating in that and you're going to own 500 options. You can never be short 500 options though. It's why the game is different, and particularly for, I'm going to assume that even though I am a professional trader, generally I approach the market the same way I hope all of you are, which is capital preservation and money management being the first and most important goal of everything that you're doing. And in that light, you don't want to put yourself in situations where you can end up being long or short more of a particular underlying if the calls you sell or puts you sell go in the money. You do not want to think that you're collecting a certain amount of premium, and as long as nothing happens, you're fine. You have to make sure that you are comfortable getting called away on everything, because the options pricing, especially when things get a little wild, a lot of new players and sometimes experienced players will find that the options that they're short can go out in price far more quickly than they anticipated. And I just want to make sure that is a cautionary note that people understand. So as far as going in with first time experience and how to get started, I think if you're starting with options, the key is, I think you can make sure that you find somewhere where you can actively keep track of price, and where you have the ability to bring up a ladder and see what these options are priced at. When it comes to not getting overwhelmed, which is the other part of your question, Johnny, I would say make sure that you're not overwhelmed by these when you hear about structures like butterflies, collars, and different structures that you can create with options. These are really just ways to reflect certain risk points of view, or put on certain trades in a way that reflect a certain risk point of view that you might have within the market. So simply a butterfly would be buying one option, selling 2 above or below it, and then buying another, usually equidistant. If you understand and learn the options theory behind what goes into those trades, what it allows you to do is find risk opportunities that have even more limited downside, but again, can allow you to structure a trade that makes sense with your perception of the market. You don't need to start out, however, understanding what a butterfly is if you are looking for long exposure to a exponential move, if you're a technical analyst or something like that. Learning these strategies and learning how options work over time will help you to better find ways to get better bang for your buck using options, if you're using them to play in a particular space. But understanding them, learning about options is critical, and you should always be learning about options. But I would not concern yourself, and that's what I'm saying. Don't get overwhelmed with trying to understand the complexity of a trade. Make sure you understand all of your best and worst case scenarios, and start with that. Start with very small money. Start with one lot, or just track price on options. See how they change over time. Watch what happens if you have an options pricing model. Watch what happens as you approach expiration. and the speed at which the change in value of options takes place as you approach expiration. If you have access to market pricing and can follow markets and just check in on where things are, I think just be a casual observer, and then you learn to ask questions and understand the market in the way that you do. I don't think there's a correct way to understand options. I know people who have made money trading options in completely different ways. So I don't want to emphasize that there's one way or a correct way. But to get started, don't take on short exposure you can't handle. Take a look at markets and track markets and options pricing before you get in. And when you get in very small so that the lessons are meaningful, but not too financially painful to start, because the first few trades usually don't work out.
Yeah, we covered that topic a bit last night with Felix and his Q&A, and talked a little bit about how my very first I guess kind of big trade was the Tesla IPO, and I did well, but then immediately, of course, got the big grand idea that I was going to be a day trader and go make all this money, and then of course lost it all. So that's definitely a topic that we touch on a few different times throughout the summit. Let's see here. So we had a good one up here from guest 210. Books to read. So what are some of your favorite books to read?
Sure. So the number one book, or the Bible that everybody, a lot of the guys in the pit are not the best readers. The guys that you meet that I work with are usually not the guy who were valedictorian of their college or wrote the tremendous essay that got all the accolades. It generally brings more of a group of people who are more the street smart type than always the book smart. But there's a nice combination. But I can say the one book that I think everybody, including people who don't even know how to read, who trade options, have read is Options Pricing and Volatility by Sheldon Natenberg. It is that's Sheldon Natenberg. I think it's Naten. I believe it's Berg. That is considered sort of the Bible of what we do. And I think there have been multiple publications. It's been around for a very long time, but the theory behind options tends to apply regardless. Again, options theory, if you want to get into the theory of options and understanding it and understanding how to put on trades and structure trades, why you would put on a certain type of spread, how putting on certain types of spreads exposes you to risk that you are interested in being in, and basically all the advantages you can gain from owning options. Options Theory and Pricing is the number one book. I think everybody eventually has to read it if you're interested in this. And I think that as you understand that when you read it, you're going to be confused by a lot of things. But if you read it and stay active in markets, it's the kind of book, even still, sometimes I'll go back to just to hear a refresher in the way that it's described, and how to understand trades, how to understand trade structures, the basis of a trade, all the theory components that are critical for just understanding options basics come from that book. As far as staying up on options pricing itself, that's what I said, as I said in the last time. I don't think there's a correct way to learn, and I know that there are different people learn differently, and different people see markets differently, and therefore should trade options according to their particular style. So the way you learn can differ greatly across people, and I don't think there's one right way to learn. But I think Sheldon Natenberg, Options Pricing and Volatility, that's our Bible.
Yep, and I'll make sure I'll put that down here in the chat box also, just for a third time.
Uh-oh.
And Johnny loves the answer.
Someone said options sounds scary. I didn't mean to scare you guys. They're good stuff too.
Let's see. So we had a couple up here that got scrolled away.
Sure.
Guest 867 asked, what do you think of the tasty trade style trading? And then guest 23 asked, what brokerage do you recommend that has low fees? Now, of course, your end is not going to be the same brokers that we have, but if you've heard anything good that you can recommend, then we can talk about that.
Okay, sure. So I don't really have a whole lot of information, full disclosure, on what the smart thing to trade is. If you're looking to get involved in commodity options at any point for whatever reason, I can say that I know if you are designated as a non-professional trader right now, it's a big plus because your fees are actually much lower from a market data perspective. But I don't know which brokerages are the best or what the margin procedures are generally. So as far as the tasty trade style of trading, if you could just go a little further into what exactly, I mean, I'm familiar, of course, with it, but specifically what you mean when you're asking how that style can be used. Just a little more detail on it, because I don't want to talk on something in detail without fully understanding the question. Sorry on that one. I'm not as familiar as I probably should be. So,
no worries, no worries. Yeah, as far as I guess a retail platform for options, I'm also not too familiar. But the one that Felix was talking about last night in the Q&A was Options House. We have a link to that one on the resources page. So if you want to check that out, that's one option. So there's a lot of different platforms, and really, I feel like for the most part at the retail level, most of the different brokers are pretty similar in terms of what they can offer and what kinds of commissions they have. I think customer service is probably one of the biggest things that actually differentiates them. So, search around, see what you can find out. We've got at least one linked up on our resources page. And so if anyone else has any good suggestions, feel free to throw it in the chat box down here.
sure.
So we have
I saw I saw the one question which I thought I'd respond to. And again, on the tasty trade question, feel free just to throw more details in. I do want to get back to your question if I can be helpful on it. So somebody asked the duration of a trade. How long does a typical trade that I have on last? So I trade out in terms of the expiration that I'll trade out to in gold. I will trade out about a year in expiration. So when I put a particular trade on, oftentimes it will last if out to that duration. There are times I will hold it for the entirety of that year. But the kind of trading I'm doing involves trading particular options against other options. So I might buy some calls a year out and then sell some calls 10 months out. And the trade is not really the call a year out, and it's not the call 10 months out that I sell against it. They are one trade together, right? So as I said in the intro, one of the things that we try to do in my particular style of trading is look for opportunities where we believe that the price we're getting paid to buy one option and sell a similar option is favorable to how that price structure is likely to pan out over time. So there will be times that I have a trade that I buy for a year and I'll sell something against it and I'll hold it for the whole year. But as far as I trade actively. I do trade every day, and managing the risk of the position is a daily thing, because options values change based on the price movement. They change based on supply and demand within the market. So I'm constantly trading, and when opportunities show up, the types of trades I put on sometimes don't happen to last very long at all. So just to give a very quick example, we trade options. We're looking at a bigger global picture, particularly with a commodity like gold. You're not just trading gold. Gold does not exist in a vacuum. It is the price on the options is determined by the price of the options in the S&P 500. That might seem silly to some people, but the correlation in terms of the price of options across assets does certainly exist. So it depends on the type of market and the way the market's reacting. But if you can pick up on a pattern, then sometimes I'll put trades on literally looking for something to happen in 2 minutes. And if it doesn't, I'll usually sell the trade out at a small loss. And if it does, then I'll go with it. So for instance, if I feel like, if I've noticed that there's a pattern of buying at night, or, the Asia session, people tend to, if for some reason gold starts to move during the Asia session, which is overnight, openings around 9 o'clock. If I have sensed a pattern that there's a buyer or a seller during that time, I will look to buy options in front of it if they get cheap. I'll do nothing if they don't. But if someone sells options in a spot like that, I might look to pick it up just to see if I can capture the short-term movement with those options, sell them out quickly. So I think the short answer to you, about a minute, and the longest is about a year for the time being.
So we got a little more detail here on the tasty trade question from 867.
Okay,
how
cool.
profitable can a contrarian non-directional portfolio-based trading in opposed to directional option trading? So I'll leave that to you. I have no idea what's going on.
Contrarian non-directional portfolio-based. Say that 10 times fast, right? Okay, let's see if I can even consider what that means. So contrarian non-directional portfolio. Okay. Non-directional portfolio-based trading in opposed to directional option trading. So if contrarian means contrarian to the market at large, right, or the general perceptions that are out there. So like you guys have, I'm sure some of you have read the book, The Black Swan by Nassim Taleb, and he talks about, okay, I got you. And he talks about, he has his own fund, right, where it's a contrarian fund. It's an option buying fund. And it's sort of, as I understand it, more of looking for those opportunities, believing that those exponential situations that I discussed are underpriced, that things happen, you're going to lose money 50 out of 51 times, but the 51st time you're going to make 150 times on your money, and it makes it all worth it. So if you are looking to play from a contrarian style as far as the general market view, as a long options player, the time that you're most likely to be able to do that is when volatility is low, right? Because you want to be able to have as much exposure to a move, if you're buying options, as possible for the lowest premium. So a contrarian play would be, for instance, to buy a whole bunch of puts if you're long the stock market when puts are incredibly low, if that's contrarian to the way it's being priced in the market. But being contrarian, if you are bullish the market, for instance, the stock market, and it's selling off, selling options, as I said, comes with a lot of complexity. So each individual scenario really requires individual analysis. And as a conceptual thing, I think that, directionally, you don't want to make things too complex. And if you can avoid adding options into any strategy is going to add complexity. So unless it's achieving something that you believe you can achieve using just the outright directional play, or that you believe that the particular structure you're putting on allows you exposure to a risk that you like, there are lots of ways to do that, and it doesn't all have to be directional. But again, every time you add options and you add strategies, you're adding a layer of complexity. So I think it's difficult to overlay this idea of options trading in general versus an entire strategy. And that's what I speak a lot about on Friday to my friend who said that I made options trading sound scary. Maybe you shouldn't listen Friday, because I give a few of the really scary examples that I think took place for people in the stock market actually over the course of the last few months. A lot of people who sell calls, for instance, on their portfolio, thinking that they're collecting premium. But when the S&P 500 ripped from 1,800 to 2,000, the amount of participation they lost out on in the matter of 5 weeks, no matter what options they were selling them too cheap relative to the performance of the market. And that's why, and I bring that up only to go to the concept of contrarian style trading or option strategies. Every strategy should be a strategy based on concepts that are not simply options based, or if they are, it's more complex than the stuff we'll be talking about here. So, I think each individual trade has to be taken as an individual trade, and to try to lump options into a bigger picture that, options can be used in a contrarian or positive way. It really depends on where things are priced. And it's important that, we all do the analysis to make sure that the options trades we're putting on reflect views and risks that we're willing to accept within the market.
Hopefully that was a good answer for you. So while really quick here, I'm seeing that we have a much higher viewer count on the YouTube stream than we do here on the actual site. So if anybody is watching from YouTube and wants to get in and ask any questions, feel free to come on over to the website's digitalstocksummit.com and then click on the watch tab up at the top, and you'll see a chat window down there right below the window where we're having this video. So feel free to come on over, ask any other questions that you have. Otherwise, we've been on for about an hour now. How are you doing there, Ben?
I'm doing great. I could talk about options all night for anyone who's willing to take the plunge.
All right, cool. Yeah. So anyone else who has any questions, feel free to come in and ask them down here in our little chat window. Here we go. What's your take on futures option trading?
Sure. So futures option trading is what I do. And I do it specifically because the underlying in gold, the way that we trade, is the COMEX futures. So options trading, and I think I said something similar early on, is that there are differences between stock option trading, future option trading, index trading, bond option trading, but generally the concepts all apply. So the people who should be considering options trading are people who, I believe, if you're starting out as somebody who is a novice, I think you should be looking at this, whether you're trading futures, whether you're trading stocks, whatever it is, as a strategy that, or using options should be something that you use to help you along the way, reflect opinions that you have in your market directionally. And that's the easiest way to get started without getting hurt and exposing yourself to some of the risks that these strategies do. Futures options trading is what I do. I think that it really depends whether you're trading the futures, for instance, on gold, or if you were to trade gold, you could trade GLD, and GLD have options, and that's an equity. So I think the type of player you are, the way you receive margin, the amount of capital you have behind you, all impacts whether or not you're able to trade options on those futures. And but aside from that, options trading on futures is really the same thing as options trading on any other underlying.
So we did get a couple other questions in here, but really quick, I actually have a question about that myself. Why, as a professional trader, why is everybody so niched down into like just one particular kind of product, or maybe even one particular stock that they just cover? And as opposed to, as a retail investor, most people, they're like, oh, they know a little bit about that, a little bit about this. It seems like it's a very different world on the professional side.
It's a great question, and it's one I ask myself all the time, and I'm forced to. And it actually, my answer has been changing to that question over time. So historically, as I mentioned, our group, when markets were wider, we were like one of the main gold groups, right? So like we had a bunch of people who traded in gold, and we still do. The number of competitors and people around us trading, unfortunately, is less. At a time where there was more edge in markets, where liquidity was less, where we got paid as market makers to take the other side of the liquidity. That was the idea historically, was that if taking oil, for instance, a big oil fund or somebody with big exposure to oil prices in their business comes in and wants to hedge, they need liquidity. Where do they go? They go to the ring, they go to the pit, and historically the pricing in options was wider. So the amount you were naturally compensated to do our job, which was to take on that risk of somebody else's, somebody who wanted to have a certain options position, we would take the other side of their options position at a price. What's happened is the spreads have shrunk, or the amount of money, the widening of the offer and the bid offer spread has started to widen in both the actual underlyings, but also in many of the options on a lot of these products. The amount that you're getting paid to take some of this risk tends to become less. So I've had to adapt my strategy because I have, and I am looking going forward to add into more than just gold, because what I've discovered over time when looking at the money I've made, lost, and adding it all up, is that much of the money I've made actually is in putting on strategies which have a bias, an opinion on them, and letting them play out. And they're the same kind of strategies I know that can be done in other markets. And when I look at some of the losses I've taken over time, I can see that a lot of it was based, racking up commissions, buying and selling things, trying to make a profit and, take both sides of a trade. And by the end of the day, realizing that I spent 12 hours in front of a computer, helped the guys at the exchange get paid by paying a lot of commissions, and really did nothing except burn myself out. So I think the style that I'm talking about here, or what you're talking about here, Jake, is looking to, and it's beneficial, is to try to understand a market first, have an opinion about a market, or have a type of opinion for a trade that you want to do. That's step one. Once you've accomplished that and you start to learn about options, then you can look to see if perhaps you can create a risk reward profile with your concept that you deem to be better than just buying or selling the stock itself. So I'm looking to become less of a niche player personally, and expand with a smaller footprint across more markets, where liquidity risk is less. By being a smaller player, having a big position does not have the potential to move markets, and that you don't have to hold positions for longer periods of time when it's illiquid. So I personally believe that smaller, more spread out is going to be the direction that I look to go. And I think it's why I talk about some of these strategies and ideas, because I think that that is the way that people should be thinking about options, not as I'm going to become the Microsoft option guy or the Apple option guy, but I'm going to learn how to utilize options in a way that allows me to take my opinions and get better risk return by using options across Apple, Microsoft, stocks, oil, whatever it might be.
Okay.
How would you compare futures option trading to straight futures trading? So the futures trading is essentially the same thing as when I say taking a directional opinion, right? If you own futures, every tick up, every tick down, if you own it, every tick up, you make a tick, every tick down, you lose a tick. When you're trading the options, there are a lot of different components that come in. One is simple supply demand. What causes options to be priced the way they are? Well, if you buy something and then someone else decides they want to buy a lot of it, it's probably going to go up in price even if nothing changed. So you could have the price of an option just go up without any movement in the underlying, or go down without any movement in the underlying. So the price of options are going to be affected by those supply demand forces, by the perception of movement within the market, and a lot of other aspects of options pricing that can determine the change in those option prices, that adds a lot of complexity in a lot of cases that you don't have to deal with just trading the futures themselves. How much money would you start with? I think that question is completely dependent on who you are, what your risk tolerance is. I think I would start, I really think, I know a guy who started getting into options recently, and the guy actually has done reasonably well for himself in lots of other profession. And I said, start with one lot. I said, it doesn't matter. It's not about the size of a trade. I can remember trades that I did, that are incredibly, some of my smaller trades that have taught me more about trading than had I done this trade any bigger. You don't necessarily need to do size of a trade to learn from it, because when your money's involved, even if it's a little bit of money, it still captures your attention more. And it's going to force you to pay more attention and follow your positions. And that's how I believe you can learn. So the smallest amount of money that matters to you, that'll make you pay attention, is probably the best amount to start with, whoever for anybody, that would be my suggestion. How do you fortify your trading psychology over time? Johnny, I love your questions. Johnny's killing it. He's sent like, I don't know how many questions you've sent, but you remind me of me, Johnny. I never stop asking questions when I'm around someone in this option space. 'Cause there's so much to learn. So I really appreciate the enthusiasm. So it's a great question about the trading psychology. My background or my undergrad degree was actually in psychology. I grew up and poker was my favorite thing to do growing up. And I think it naturally sort of was what got me interested in trading and markets. And I think I take a lot of my mentality from playing poker. And I think particularly in what have been very tough markets for options traders in the past couple of years, surviving through that, I think what I've learned is there have been a number of times that I thought, the world was coming to an end and it didn't. And there have been a number of times where I realized that the world could come to an end, and it always can come to an end, but you just have to accept that and be happy with the analysis that you do going into a trade and your reasoning for putting on a trade or putting on certain types of risk. So I think that the real thing for the psychology of trading, the most important thing personally for me, it differs by person, of course, but is that you can put a trade on and walk away. And if you're wrong, you can accept the fact that your reasoning was solid and then try and learn from your reasoning, and that's the approach you're taking. You're not looking to be right all the time because everyone knows that's not possible, and that you're judging yourself and that you're judging your performance honestly and critically, but that you're doing it in such a way where when you make a decision, if it's wrong, you accept it and you accept that you liked or had reasons and premises for the reasons you made your decision. And I think that's the most critical thing, is to judge yourself on the process. I found this very funny thing, actually, and it's funny that you asked it, because I've found a number of times, strangely enough, where I'll go for a prolonged period of time where I will either break even or I'll start losing a little bit of money, but I get this weird feeling that, I'm doing things right. And somehow when I get that feeling over time, I find that it's usually soon after that things start to work out well. I think keeping a positive attitude, particularly in what can be grueling markets, it's not always about being the smartest guy. It's about being there and being alert when opportunity presents itself. So I think having a positive attitude and not being the type of person who beats yourself over the head when things goes wrong, but can take a calm approach to understanding thought process in a trade and how to learn from it and how to approach things going forward as a result of it. You got to be comfortable with your decisions. You got to be willing to stand by them, and you have to be willing to lose because there are no free lunches out here for sure. And if you're the type of person who can't handle losing a few times in a row and that gets you mentally bent out of shape, then I don't think trading's right for you. But if you can reconcile with yourself and make decisions based on things that you trust in and trust your decisions and accept the consequences when they're wrong, then I think that's really, from my perspective, tops in trading. Positive attitudes and a willingness to accept and learn from mistakes, but simultaneously not getting either too excited or too disappointed when a trade goes right or wrong, because a lot of times you put on a bad trade and it works, or you put on a good trade and it doesn't work. So you have to be intellectually honest with yourself in the way you judge yourself. Why do I trade options as opposed to futures? Good question. So I trade them because that's where I came up. I got a job working as an assistant, as I said, working on the floor of the COMEX as a clerk, running around checking people's trades before it all became digitized. And that's what we learned to do. Now we're doing, as I said, there are a number of different styles of trading that are sort of incorporated into what I do. And I would even say that people who do the same thing I do, we don't all do the exact same thing. There are different types of ways that you can trade and use options. But I think the number one, if I had to say it in one sentence, and I said this earlier, but I would say it again, is when you understand options, you can find places where you can create risk reward that better reflects your opinion of the market than you might by just trading the futures. Futures allow, if you buy futures and they go up, you sell them, they go down, you lose. But sometimes the perception is not that simple of a market. And to the example we did much earlier in this call, where we talked about the situation where you bought the 110 calls on the $100 underlying asset. That was a situation where you had an opinion on the market within certain places. You didn't necessarily think it was going up, but you thought if it did go up, the potential for a breakout was great, and therefore the risk return you got by owning the options was greater. So what I'm looking to do, and what a lot of people in our business are looking to do, is to try and find those opportunities where the options provide a risk profile that reflect your perception of a market better than just a directional bias. So let's see, what else we got? Anything else, Jake?
Awesome. That's we're all caught up. So I think I'll actually give you another question here.
Sure.
And in the meantime, if anybody else has any good questions, throw them in here. Otherwise, we'll start wrapping up here in just a few minutes. So last call. Let's get some last good questions in here. And in the meantime, my question for you is, if you were to start all over, completely from nothing, no contacts, just maybe just the knowledge that you have, what area of trading would you go into? And how would you go about trying to find either a career, or I guess maybe even going independent if that was the route that you wanted to go? But either finding your own career, starting over, what would you do?
I don't, to the point of what I just said earlier, I don't really regret much. And I think what I did made a lot of sense. I wanted to learn trading. It's what I wanted to do. I wasn't entirely sure why, but I really thought I wanted to learn trading. So what I did was I actually graduated college in 2008 and got a job at one of the banks. And that was a tough time to graduate, as many of you may know. So I got a job. I thought, everything was great. And then half my class, including myself, unfortunately, was laid off. And I was looking at a situation where I had no clear path. You couldn't get a job, working at the local pizza shop at that particular time, particularly not in finance or in trading. And what I did was I went to the first job I could get, where I thought I would get exposure to trading and be around people and learn from people. And I think that's really been my attitude. And at opportunities like this, even though I'm doing the speaking at this point, there's always learning from other people. And I think anytime you put yourself in a situation where you're around people that you can learn from, I think that's ideal. I can look back and think of a lot of things I might have done differently, and moments I could have realized that I was spending too much on things that were not worth my time. But that's all hindsight. I think the rule of thumb in any of this is just to be around people that you can learn. I'm a believer that over the long term, if you're around people that you can, and you find things that you're interested, that you're going to find the best space for you. I think options trading makes a lot of sense for somebody of my personality, who likes to reflect longer on just the structure of setting up a trade and analyzing a trade. It's different than somebody technical analysis exclusively, or somebody. There are so many different ways to trade, right? So I would never say there's one answer for everybody. I really think it's personality dependent. And I'd say just be in a position where you can learn from other people, whatever that is. That's the way to go if you can.
Awesome. So we got one last question that was thrown in here, and that was just, what is your favorite strategy or your favorite setup?
Sure. So essentially, and I did, Jacob and I met at a talk I had given at another expo, and the talk I gave was called "Why Directional Traders Need to Understand Options." And in that case, the strategy, so to speak, when we talk about the concept of what I was looking for in the examples that I gave in that presentation, was looking for opportunities where I had an opinion about a market and the likelihood, and trying to find ways that reflected that opinion where I thought I could get, as we discussed, or a exponential payout relative to the risk. And most simply, that is the strategy. Now, is it true that there were a lot of different that I utilized in getting there? Yes. But the fact is, it wasn't those particular strategies. It wasn't that I was long put spreads or long puts versus calls that necessarily was what made the trade work. It was a general concept that options were underpriced, that there was a potential for movement, or that these situations do exist when they are underpriced and you believe there's potential for movement, that in these particular times, you can look to be buying options to take advantage of it. And that's the strategy that I think makes the most sense, again, for people playing from the long side. I think that's really the goal of most of what I do. And it's less, again, strategy. Just be careful with this word strategy. It gets tossed around a lot. Like there's something you do. If you keep doing it, it keeps working. Keep in mind what we talked about with options pricing. We were talking about expiration. We're talking about the supply and demand within the market and how that can change people's values in the market and how it can change the value of options. No one strategy accounts for all of those things. Everything has to be taken within the context and the confines of what's around us. And the idea that options allow a strategy in a market or something like that, usually strategies like that are just missing detail. That's where the profitability is, because they are not reflecting all the risk that's there. And that's why I hope that people will watch the piece that I did. It's about 18 minutes long when Jacob releases it on the Digital Stock Summit. I believe you said Friday, right, Jake?
Yep.
Okay, yeah. So I hope you guys will watch that, because it's some of the pitfalls actually of so-called strategies. To be aware of some of the potential risks that might not be so obvious with these strategies, and how to avoid them and trade better. So as far as you said, strategy, i.e. spreads, calendar, butterfly, etc. So spreads is generally the answer. I mean, I will own, again, I could own an outright options exclusively. I could own spreads if I think that, for instance, a put spread, right? If you believe that by expiration, if you're holding something to expiration, and you think that a gold's trading around 1,200, and you think that within the next 2 months and that expiration, it's going to go and sit at 11. Well, I might want to buy the 1170.50 put spread, meaning that I get a put spread because I'm selling an option. I'm not just buying the option, but I'm selling an option at the point where I no longer think that the down move will continue. So that's a way of spending less money to be able to capture the risk or the potential for movement that you're seeing within a given market. And usually, but I could turn that into spreads. Again, you can turn a put spread into a butterfly and trade the strategy differently as the market moves, but the money is not made as an options trader. And if people are thinking about trading options, understand that the money is not made in understanding how to put on a butterfly. The money is made in a concept within the market about where you believe options are priced given the underlying movement. And then you can start looking at using whether it makes more sense to use outright options, call spreads, put spreads, butterflies, condors. You can do any of these things. But it starts with the concept, and then the strategy is usually secondary to it.
All right.
Don't have anybody to learn from. Guess 289 doesn't have anybody to learn from. I want it more than anything in the world. Well, that's good. So, or what detail we'll have following. If anybody wants to see following this, you can email me at my name, Ben Ryan at Options Hedger. That's OPTIONS Hedger, HEDGER.com. And tell me what you're interested in learning about. It's going to be 10. We're very early in our stages right now, but I truly want to get to finding. I know there are a lot of you out there who want to learn about options and want to understand how you can use these strategies better. that's why I really appreciate Jacob allowing me to use this forum, because it's so interactive. And the best way for people to learn, I believe, is interactive. So feel free to email me, feel free to tell Jacob, and perhaps we can do something going forward together, where we could put on a few classes or something like that. I'm happy to do it. So email both of us, and we can do, because I definitely want to be doing some teaching going forward, and all I need is students. So that'd be great.
Yeah, absolutely. I'm more than happy to do something like that. So if you guys are all interested, let us know. Last night I gave out all my contact information. Find me on Twitter at whitishj, and that's on my profile page on here. And Ben's website is watching the comments coming down here. Ben's website is on his profile as well, so you can find both of us. Awesome, cool. I think we'll go ahead and start wrapping things up here. Also, I'll throw in, for anyone who is interested in learning about how to find mentors, Jesse, aka Psycho on Wall Street. His session was live today. He has a really great one talking about how to find people who will actually be a good mentor fit for you, and not just somebody that you're paying to kind of sort of learn from. So that'll be a good resource. Tomorrow we have coming up Steve Burns, Dan David, and Dr. Alan Ellman. I mentioned him at the very beginning. He kind of gave me a pretty good lesson on options. So if you're interested in options, he's a really great one to check out. Dan David's pretty cool. He's the co-founder of Geo Investing, and he talks about doing due diligence on investing in China. Steve Burns is a pretty prolific author and reader, talks about swing and trend trading. And then tomorrow night, same time, 5 p.m. Pacific, 8 p.m. Eastern, is Tim Grittani, a rather famous day trader in the Profitly circles. So that'll be another fun Q&A. And then, of course, we've got Ben coming up again on Friday with his session that he was talking about. So anybody that's interested, definitely check out those sessions. Feel free to get a hold of us. 867 here asked about Ben's Twitter. I don't think you have a Twitter, do you, Ben?
Not yet. I would say by the end of April, I'll have a Twitter. Right now, I'm with getting good content up, and once that's done, and as I said, interactive conversations like this one, that's really been my focus. And then after that, when that's used on Twitter, and appreciate your following me. But for now, optionshedger.com, and again, just feel free to email me or Jake, and we'll really happy to work with anybody who has continued interest in learning more about options. And Nassim Taleb, by the way, is the name of the author of the Black Swan. I know someone asked that. It's Nassim. His last name is Taleb. A great book.
All right, there you go. So anyone else has any questions, feel free to follow up with us. If you can't, for some reason, find Ben's info, feel free to get a hold of me, and I'm more than happy to connect anybody. So awesome. Thank you all so much for coming out tonight, and hopefully we'll all see you in the Q&A again tomorrow. And in the meantime, everyone have a wonderful evening, and enjoy all the sessions tomorrow. And thank you, Ben.
All right. Got the opportunity to speak with you. I look forward to doing it again soon.